This video will take you through the process the auditor follows to complete the subsequent event review. The subsequent event review is carried out at the completion and review stage. Its aim is to identify if events since the year end have an impact on the current financial year and require inclusion in the financial statements. The auditor must identify any post-year events and apply them to the accounting standard IAS 10 events after the reporting period. Carry out audit procedures during the review as per the auditing standard ISA 560. Identify and discuss with management any changes needed to the financial statements, and consider the impact any events identified have on the audit report and opinion. IAS 10 states that there are two types of events that occur after the reporting period. They are either adjusting or non-adjusting. The definition of adjusting events are events that may have been discovered after the year, but where there is evidence that the conditions actually existed at the reporting date. An example would be a receivable customer that has communicated their inability to pay after the year end. It is unlikely that their inability to pay happened overnight. They were unable to pay at the period end, but did not communicate this until after the year end. Therefore, the advice from the standard is to write off the debt as it should be an adjustment in the financial statements. The definition of non-adjusting events are material events where the conditions did not exist at the reporting date, but arose after. They are material enough to feel necessary to inform the users, and so should be disclosed in the financial statements. An example could be a disaster after the year end, like a factory fire. This event would impact on future productivity, and so would be misleading not to inform the users of the financial statements. A disclosure note explaining the event and its impact would be required. The entity should include any subsequent events as per the accounting standard treatment. The auditor must then review any events and their treatment in the financial statements, plus perform other audit procedures to obtain evidence of any further events that may have been missed. They do this with the guidance from their auditing standard ISA 560. ISA 560 subsequent events states that sufficient appropriate evidence must be obtained on events that occur from the year-end date to the date the audit report is signed. During this period, the auditor has an active duty to obtain evidence and identify events which may need adjustment or disclosure in the financial statements. Having an active duty is to perform audit procedures. Examples of typical audit procedures carried out are inspection of post-year-end financial information, for example management accounts. This may identify significant changes to performance that may need to be communicated to the users. Inspection of board minutes of meetings held since the year end. These may identify significant events that may have not been included within the financial statements. The auditor will also review the procedures carried out by the entity when identifying events and preparing the financial statements. It may highlight a risk of subsequent events not being disclosed correctly. This may mean the auditor needs to increase the amount of work on this area. The auditor will obtain a written representation from the directors that events have been disclosed correctly. This acts as backup evidence, and other audit procedures must also be performed. Inquiry with the management of the entity is also likely. The auditors will ask the management if there are any events that have occurred that may need disclosure. Inspecting correspondence, for example with legal parties, may identify significant events affecting the entity. If audit procedures identify events that have not been included correctly or omitted from the financial statements, the next step is to discuss these events with management. The auditor should explain the changes necessary to the financial statements. They should then inspect the financial statements to ensure amendments to the balances or disclosures have been made as discussed. If management refuse to amend the financial statements, there will be a misstatement in the financial statements. If the auditor has concluded that this is material, then this will impact on the audit opinion. If management cannot be persuaded to make the changes, it is likely that the audit report will be modified with a qualified opinion due to a material misstatement. If the event has been disclosed correctly but it relates to a material uncertainty surrounding the client, the auditor may consider modifying the audit report with an emphasis of matter paragraph. Remember that this type of audit report will still state that the financial statements are true and fair, but reference will be made to the event disclosed in the financial statements to highlight its importance. Once the audit report has been signed, it tells us the audit report has a passive duty to identify and react to events discovered. Therefore, once the audit report is signed, the financial statements will be issued and the AGM will be held. During this period, if anything comes to light regarding a material event that should have been, but has not been disclosed in the financial statements, the auditor must take necessary action. Remember, the auditor has no obligation to perform audit procedures during this period. If they become aware of an event at this point, they must first discuss the event with the management and explain the changes needed to the financial statements. They must then perform audit procedures to identify whether the changes have been made correctly. The auditors must then officially withdraw their audit report. Remember, this would have been prepared based on the financial statements before the event was discovered, and so a new audit report needs to be issued to take into consideration the event that's come to light. If the management have made the changes to the financial statements, the auditor will issue a new audit report with the new date signed. They will also modify it with an emphasis of matter paragraph that highlights that the audit report has been reissued. If management refuse to make necessary changes, the audit report should be modified with a qualified opinion due to a material misstatement. This information must be communicated by the auditors to ensure the users are aware of the events not disclosed. I hope you found this video useful. Thank you for watching. This video will cover the going concern review. This forms part of the completion and review stage of an external audit. The aim of the going concern review is to ensure the auditor has considered whether the client is likely to continue in the foreseeable future, and whether they have prepared their financial statements, including appropriate disclosures. The entity must decide when preparing their accounts whether they believe they will continue to trade in the foreseeable future, for example within the next 1 to 2 years. Based on their decision, the format of the financial statements will change. If yes, then they will prepare their financial statements using the normal or going concern basis. This is how we see most financial statements being prepared. If they are not sure, maybe due to financial difficulties, then they should prepare on the going concern basis but with additional disclosure. This disclosure should then explain the uncertainties to inform the users. If they believe they will no longer continue, for example if they have decided to close the business or it is impossible to continue trading, then the financial statements will be prepared using the breakup basis. It is the director's responsibility to assess their ability to continue when preparing the financial statements. They should therefore review this using the cash flow forecasts and budgets, considering finance needs and sources of finance, and their profitability. With the financial statements now prepared demonstrating the client's perception of their business, it is the auditor's responsibility to review them and decide whether they agree with the basis. ISA 570 states that the auditor must identify if the financial statements are being prepared using the appropriate basis. The only way they can do this is to perform specific audit procedures that will obtain evidence on the client's ability to continue. This is left to the end of the audit to ensure that events since the year end can also be reviewed, as these may have an impact on their foreseeable future. The auditor should look for indicators of going concern problems. For example, indicators include imminent bank overdraft reviews by the bank, slow payments to suppliers, failure to pay staff, customers not paying or significantly slower to pay, defaults on loan payments, tax payments missed and fines, industry or competitor changes, loss of market share, net current liabilities, net cash outflow, and making losses. The auditor should perform audit procedures to obtain evidence that supports or questions the decision made by the directors on their going concern basis. The evidence that will typically be obtained will be correspondence from external sources, board minutes, post-year-end accounts, cash flow forecasts, loan agreements, written representations, and inquiry with management and company lawyers. Correspondence should be reviewed to identify any possible issues that have not been highlighted by management. Customer correspondence should be reviewed to identify problems with customer relationships and if any big customers are no longer trading or no longer trading with the entity. Supplier correspondence should be reviewed to identify if suppliers are supplying on time with credit or if there are any problems, for example, if the entity is not paying on time. Bank correspondence should be reviewed for evidence such as if a bank overdraft review is due, which could indicate cash flow problems if it is in use. And tax correspondence would be reviewed for evidence of non-payment, fines and penalties. Board minutes would be inspected to identify discussions on any issues that could cause problems for the entity. Review of the board minutes before and after the year end would be advisable. The auditor would inspect any post-year end financial information such as management accounts or interim financial statements to identify if the performance of the entity is consistent with the current year being audited. It may highlight if revenue and profits have fallen or if there are large sales of assets just after the year end. Any of these issues should be discussed with the client if detected. An analysis of cash flow forecasts the client has prepared would also help identify potential going concern issues. The auditor should assess how reasonable the assumptions are that have been used to prepare the forecast. Audit procedures such as agreeing the opening balance to the actual balance in the cash book, comparing income and expenditure from the budget to the movements in cash in the forecast, and post-year accounting information will all go some way in deciding how reliable the cash flow forecast is. Then, considering the level of cash planned for the business will also help decide whether the client is a going concern. Negative cash planned would be an indicator of going concern problems, where disclosure may be necessary in the financial statements. Inspecting loan agreements held by the client is important so the auditor can highlight if any loan covenants exist or if a loan repayment is due. If conditions are attached to loans, for example, the company must ensure debt is kept below a certain limit, the auditor must assess if these covenants are in breach. Inquiry with management to discuss their future plans or give explanations to anything found by the auditor will help them decide if going concern disclosure is required. Inquiry with the company lawyer will identify any existing litigation issues which could cause future problems for the entity. If a court case is looming, compensation payments may be possible and an effect on their reputation may affect future revenue growth. Audit procedures such as these mentioned will assist the auditor in gathering evidence to decide whether they agree with the going concern basis used. If in agreement with the client and the entity is a going concern, there is no further work needed. If there are issues or the auditor disagrees with the basis used in preparing the financial statements, then the auditor must discuss this with the client and advise what will happen next. Firstly, if the auditor believes the entity has a going concern problem and disclosure is necessary, as long as disclosure is adequate in the financial statements, then the auditor can issue an unmodified, unqualified opinion. However, the audit report should be modified with an emphasis of matter paragraph to highlight the uncertainty and make reference to the disclosure included in the financial statements. If disclosure is needed and the client refuses to include anything in the financial statements, the auditor should discuss the impact this will have on the audit and the audit report. From the auditor's perspective, If they believe disclosure is required, then without it there is a material misstatement. The audit report would be modified with a qualified opinion. This is likely to be an adverse opinion and the basis of opinion paragraph explaining the uncertainty to the client's future. In this video we have covered the aim of the going concern review, how going concern affects the financial statements and the director's responsibilities, the auditor's responsibility towards going concern disclosure, the typical indicators of going concern issues for the entity, the typical audit procedures carried out by the auditor to establish whether the client is a going concern, and finally, the conclusion of the auditor's work in this area and how it affects the audit report and opinion. I hope you found this video useful. Thank you for watching. This video will explain the purpose and practicalities of written representations. Written representations are written confirmations of certain matters from the directors to the auditors. It is a form of evidence to assist the auditor in forming their independent opinion. They are often also referred to as the letter of representation, but both terms mean the same thing. The purpose of written representations as evidence is to obtain confirmation that management have fulfilled their responsibilities in preparing the financial statements. This includes preparing the financial statements in accordance with financial reporting frameworks, providing relevant explanations, information, books and records to the auditor, and including all transactions and events within the financial statements. Written representations also act as supporting evidence of matters that the auditor feels necessary to form sufficient appropriate evidence. This could be if required by auditing standards, or if there are areas of the financial statements that are more challenging to gather on, for example balances that contain estimates or judgment decisions made by the directors. Guidance is given from ACCA F8 written representations. For there to be enough evidence to form an independent opinion, the auditor must obtain a written representation statement from the client management. As written representations are client-generated, they may be subject to bias and are therefore not the most reliable forms of evidence to obtain. This is why the auditor requests this at the end of the audit process, so they can evaluate the evidence collected so far and ensure that, with the written representation, evidence as a whole is sufficient and appropriate. When written representations are obtained, if they are not consistent with the evidence collected so far, the auditor must consider whether the representations are reliable, whether audit risk, the risk of giving an inappropriate opinion, is higher than first planned, and if the audit procedures completed so far are enough and whether further testing is needed. If deemed unreliable, the auditor may decide they can no longer continue the audit engagement. It will also potentially affect the audit opinion, as if not reliable, there will be not enough sufficient appropriate evidence and so a disclaimer may be issued. If the management provide a written representation to the auditor with no inconsistencies, then the auditor will be satisfied that, as evidence, this will assist forming the audit opinion. If the management refuse to provide written representations, steps should be followed by the auditor. Firstly, the auditor should discuss with management the reasons why they will not provide written representations. They should also explain the importance of them to the client. They should then consider whether client management integrity is impaired and whether other evidence gathered internally from the client may be unreliable. If the client will still not provide the written representation, then the auditors do not have sufficient appropriate evidence. They will therefore modify the audit report with a disclaimer stating that they are unable to form an opinion. The format of the written representation can vary. It can be a written statement prepared by the client, or it can be a letter or statement prepared by the auditor and then finalised by the client on headed paper. Either way, the written representation must be signed by a senior member of the management of the client, for example, the Chief Executive or the Chief Financial Officer. The written representation must be signed on the same date that the financial statements are authorised. This should be before the audit report is finalised, as the opinion needs to take into account the content of this evidence. To conclude, we have covered written representations are evidence required by the auditor. Their purpose is to confirm matters of importance by the directors and also back up areas where evidence has been difficult to obtain. Guidance on this evidence is from ISA 580. They are not always the most reliable evidence, and the client may refuse to provide this written representation. The auditor must consider the impact any issues regarding representations have on the audit report, and if obtained, ensure they are prepared, dated and signed before the audit report is prepared. I hope you found this video useful. Thank you for watching. We are going to cover the completion stage of an external audit in this video. The aim is to outline the components of this important stage so you have an understanding of the work required. The audit process so far has seen the following completed. The acceptance stage, where the auditor considered whether they should accept the audit engagement. The engagement letter, where the client and auditor agreed the terms of the audit assignment. The planning stage, where any audit risks were identified and a strategy formed, documenting a plan needed to complete the audit properly. The assessment of control systems, where the auditor identified any control deficiencies and tested controls for their reliability. And the substantive testing stage, where the auditor completed audit procedures to identify any material misstatements within the financial statements. The completion and review stage is where most of the audit work has been completed, and it is now time to review what has been done and finalise any outstanding issues the auditor may have. There are several specific pieces of work that must be completed at this stage. Each one is of importance to the auditor. These include the overall review, the evaluation of misstatements, subsequent event review, going concern review, and obtaining written representations. The overall review is where the auditor will review the financial statements and the audit file. Here, the auditor should ensure that both the financial statements and the audit file are complete and consistent with one another. The financial statements should be reviewed at the end stage to ensure an appropriate financial reporting framework has been followed, any relevant laws and regulations have also been followed, the information within the financial statements is consistent with other published information, for example the Director's Report, and whether the audit team has addressed the important issues within the balances and transactions. Analytical procedures are used at the completion stage to ensure the financial statements have been reviewed thoroughly. These procedures must be carried out by the auditor, and it is one last attempt to ensure sufficient appropriate evidence has been collected on any changes or unusual events included within the accounts. The audit file is reviewed at this final stage to ensure the evidence collected is sufficient and appropriate. At the completion stage, they must ensure the evidence will support the audit opinion that will be formed. The documentation within the audit file will be reviewed to identify whether the audit was planned properly, whether auditing standards have been followed, has sufficient appropriate evidence been gathered, and if conclusions made are appropriate. This work is usually carried out by the audit manager, reviewing the work of the audit team. A disclosure checklist may also be used in many audit firms as a prompt to ensure the audit team has considered all that is necessary and that there is evidence collected in the audit file. In addition to reviewing the audit file and financial statements, the auditor must also review the misstatements that were collated during the audit process. At the planning stage, the auditor decides what is going to be a material misstatement, for example, 6% of profit. Material misstatements must be detected by the auditor so they can highlight to the client for amendment. All misstatements detected are usually recorded on a spreadsheet during the course of the audit. At the completion stage, the auditor should evaluate these misstatements to see if there is a material misstatement that should be amended in the financial statements. Remember, this could be an accumulation of many small errors within a balance that add up to a material misstatement. All misstatements identified, with the exception of very small ones, are discussed with the client for amendment. If any are not amended by the client, the auditor must assess whether the remaining errors are material to the users. This should be reviewed individually and in aggregate. The auditors should then explain the impact, if any, on the audit report and obtain written representations to confirm the uncorrected errors are immaterial. As well as the overall review and the evaluation of misstatements, the auditor has some specific audit procedures to carry out at the completion stage. Subsequent event review is one of these areas to cover. This is where the auditor reviews events that have occurred or come to light since the year end. They must consider whether there should be amendments made to the financial statements. This process reviews whether the accounting standard IAS 10 has been followed correctly by the entity. The standard states that material events after the reporting period should be included in the current period's financial statements. Audit procedures to identify events must be carried out in the period up to when the audit report is signed by the auditor. The going concern review is another process the auditor must follow at the completion stage. Audit procedures must be carried out to assess whether the going concern status of the entity is disclosed correctly within the financial statements. If the auditor disagrees with the going concern disclosure or lack of it within the financial statements, discussions must be made with the client to recommend amendment. Written representations are written confirmation of matters from the directors of the entity to the auditors. Certain matters must be confirmed in writing by the management to ensure the auditor has sufficient appropriate evidence on the financial statements overall. If the management will not provide written representations, again, discussions must be made with the directors. Without written representations, there will be a lack of sufficient appropriate evidence, which would have an impact on the audit opinion. Subsequent event review, going concern review, and written representations are all carried out at the completion stage, as this is the final stage of the audit process. This enables the auditor to review the year being audited, plus events that have occurred since, to ensure there are no omissions from the financial statements and disclosures are in accordance with accounting standards. We cover these three processes in separate videos due to the detail needed in understanding them fully. All 5 areas have been covered from the completion and review stage of an external audit. Once complete, in simple terms, the audit is complete and no other evidence would be obtained. The next step, based on the financial statements and evidence collected, is to form the independent opinion on them and prepare the audit report. I hope you found this video useful. Thank you for watching.
This video is going to cover the topic of the audit report. The audit report is the final report at the end of the audit process that is communicated to management and the shareholders of the entity. It is within the audit report that the independent audit opinion is shown. In this video we will be covering the following topics: regulations surrounding the audit report, the contents of the report, forming an opinion, and communicating to those charged with governance. The audit report is regulated by auditing standards. ISA 700 Revised is the standard that informs us of the objectives and format within the report. The standard states that the objectives of an auditor are to form an opinion on the financial statements based on the conclusions made from the evidence collected, and to express their opinion clearly through a written report. When the auditor forms the opinion that the financial statements are true and fair and properly prepared, they issue an unmodified opinion. If there are no issues to draw attention to for the users, the audit report will be referred to as an unmodified audit report. The contents of an audit report are laid out in the standard. This is based on an unmodified audit report where there are no material misstatements and no issues unresolved during the audit. Within this audit report, there should always be the title, clearly showing that this is an independent auditor's report, the addressee, showing the intended users of the audit report, the audit opinion is included underneath, where they will state that the financial statements give a true and fair view, basis for opinion, which explains the professional standards used when reaching the opinion shown above. This helps give confidence to the users and includes more details on the opinion given if necessary. Key audit matters is next. This section will highlight any of the important matters that have been dealt with during the course of the audit. Its purpose is to highlight significant areas to the users to help with decision making. This is compulsory for listed companies and can be included for non-listed as it is best practice. Other information explains the management are responsible for the preparation of the other information, which may be published with the financial statements. An example would be the director's report. Remember that the auditors only review the other information submitted for any inconsistencies with the financial statements, and therefore do not audit and form an opinion on this area. Management responsibilities is shown as a paragraph explaining the key responsibilities of management during the audit process. Remember, they must prepare financial statements free from material misstatements, using good control systems in accordance with relevant accounting standards. Auditors' responsibilities are also included in a paragraph, explaining that they must form an opinion on the financial statements based on sufficient appropriate evidence collected through audit procedures. The audit was conducted in accordance with ISAs, and the audit was planned and performed to provide reasonable assurance on whether the financial statements are free from material misstatement. Other reporting responsibilities would be included underneath this, if there are other responsibilities to report under local legislation and regulations. Finally, at the very end would be the engagement partner's name, signature, and address of the audit firm carrying out the audit and the date the audit report was signed. We have now seen what would be included in an audit report if the auditors conclude that the financial statements are true and fair. However, when concluding an audit, it may not always be appropriate to state this, and there may be complications that need to be communicated. The forming of the audit opinion is usually made by the audit or engagement partner, based on all of the evidence collected and discussions made with the audit team and the client. The format of the audit report may therefore change depending on what they conclude. The audit partner initially needs to decide whether the financial statements are true and fair. That will be a simple yes or no. If it's a yes, then as we've mentioned before, with no unresolved issues and the financial statements being true and fair, then the audit report is unmodified with an unmodified audit opinion. Another term you may see used is an unqualified opinion, and this is just another term for an unmodified opinion. Okay, going back to the audit partner. What happens if the audit firm have concluded that the financial statements are not true and fair? Well, next they need to ask themselves why. It will either be because there is a material misstatement still within the financial statements, or there is a lack of sufficient appropriate evidence obtained during the audit process. For each of these issues, the auditor must modify the audit report with what we call a qualified opinion. The auditor then needs to decide whether the matter is material or material and pervasive. Material means the matter is important to the users. This is based on the auditor's judgment, referring also to the guidelines given on materiality. For example, an item is material if it is greater than 5 to 10% of profit, 0.5 to 1% of revenue, or 1 to 2% of total assets. Material and pervasive means the matter is very significant to the users. In simple terms, it means the matter is so fundamental it makes the financial statements unreliable. Focusing on if there is a material misstatement. If the matter is concluded as material, the auditor must modify the audit report. Remember, the standard audit report is an unmodified one, and so if the opinion wording needs to change, the auditor is modifying the audit report. The audit opinion for a material misstatement would state that the financial statements are true and fair except for the matter that was not corrected. This is known as an except for opinion. To give you an example, let's say the auditor discovered a receivable customer was unable to pay the client, but the client refused to write off the debt. If the debt was 20% of profit and the customer can clearly not pay, it would be a material misstatement as the client has not followed the correct accounting treatment. If the client refuses to amend the financial statements, the auditor must modify the audit report with a qualified opinion due to a material misstatement. As it's material, the opinion is an except for opinion. If the matter is material and pervasive, as we've said before, this will mean that the financial statements as a whole are unreliable. The auditor must modify the audit report, but this time the wording in the opinion section will state that the financial statements as a whole are not true and fair. This is known as an adverse opinion. An example would be if the client had not presented the financial statements using the correct going concern basis. If the directors had produced the accounts using the going concern basis on the assumption that they could continue in the foreseeable future, but the auditors did not believe this to be realistic, the accounts could be seriously misleading to the users. If not resolved, the auditors would disagree with the accounting treatment and so modify the audit report with a qualified opinion. The matter is material and pervasive, and so an adverse opinion would be included, stating the financial statements are not true and fair. Going back to deciding whether the accounts are not true and fair, this time let's look at the types of opinion if it's due to a lack of sufficient and appropriate evidence. Once again, the auditor needs to decide whether the matter is material or material and pervasive. If material, the auditor must modify the audit opinion. Similarly to our material misstatement, the wording will indicate the impact of the lack of evidence, making it clear the lack of evidence is in isolation. The opinion will once again be an except for opinion. An example would be if the client did not perform an end-of-year inventory count. If the auditor attends, they are able to verify the existence of inventory. If existence cannot be verified by other methods, there is a lack of sufficient and appropriate evidence in this matter in isolation. If evidence can be obtained in all other matters, then the audit report will be modified with a qualified opinion due to a lack of sufficient and appropriate evidence. The matter is material, and so an except for opinion is included. If the lack of sufficient and appropriate evidence is material and pervasive, then the auditor has a dilemma. Without enough quality evidence, they will not have the confidence to provide reasonable assurance on the financial statements. The auditor will modify the audit report with a disclaimer. The disclaimer will state that they were unable to form an opinion. An example would be if the client has refused to give any written representations to the auditor. These must be obtained as evidence and must confirm matters such as that the financial statements are free from material misstatement, events have been disclosed correctly, and all books and records have been provided to the audit team. Without such confirmations, the auditor will not have the confidence to provide reasonable assurance on the accounts. If the directors cannot be persuaded to provide a written representation, the auditors would have no choice but to modify the audit report with a disclaimer. So far, we've established that if the financial statements are true and fair, the audit report will be unmodified with an unqualified opinion. If the financial statements are not true and fair, whether it be due to a material misstatement or a lack of sufficient appropriate evidence, the auditor must modify the audit report with a qualified opinion. They then need to decide whether the matter is material or material and pervasive to conclude the wording within the opinion section. There is one more type of audit report modification we must conclude with. The final scenario is if the auditor has concluded the financial statements are true and fair, but there is something of fundamental importance within the financial statements that the auditor wishes to identify. There are three scenarios. The first is if there are concerns over the client's ability to continue in the foreseeable future. If this has been disclosed adequately in the financial statements, then the auditor will highlight this important issue in the audit report. This will be shown under the heading Material Uncertainties Relating to Going Concern. Another paragraph that may be included is an emphasis of matter paragraph. This paragraph will highlight something that has been included in the financial statements, but is of significant importance to the users. This could be, for example, a large provision and disclosure for an ongoing court case. The other would be a section headed Other Matters. This would include anything else that is of importance in understanding the entity and the financial statements. For each of these sections, the issue will be included in the financial statements and therefore they are only present to draw attention to the matter. Communication to those charged with governance is outlined in ISA 260 and ISA 265, where it highlights the formal communication of issues between the client and the auditors. The first formal communication is the engagement letter, where the agreement of responsibilities and the outline of the auditor's role is documented and signed. The next formal communication is the management letter, where any issues found, including deficiencies in control systems, are documented. Any recommendations are also included in this report and usually communicated at the very end of the audit process. The audit report, as we have now seen in this video, outlines the overall independent opinion made on the financial statements. This report is included with the finalised accounts and presented at the AGM for the shareholders to review. If there are potential modifications to the audit report, these should be discussed as soon as possible with the client before the audit report is signed. I hope you found this video useful. Thank you for watching.